Get filthy rich in 2023. The Fed will stop raising rates in the next 1 or 2 meetings. US economy is ripping. There's no recession in sight. There's a record $5 trillion cash position in money markets getting ready to pound the stock market, bond market, commodities market, and digital currencies markets. Inflation in goods, energy, services, and wages are all falling while unemployment stays strong. This is what the Fed wants to see. So get greedy now. Buy these 5 stocks. Our high-risk portfolio has a total return of 311% since 2021. It's outperforming the SPY's 12% return over the same time period by 2,486%. Here's our current trade alert recommendation per unit of investment. If you're a member, you can log in, type in how much you want to invest, and it'll automatically calculate the right amount of shares. Currently, we have stayed put with no changes to the portfolio as we rack in record profits this year with 20 shares of UVXY, the crash insurance, coming in currently at 4.47% of the portfolio. We've got a US Treasuries position betting on interest rates falling for the next 2 years with 49 shares in ticker TMF currently coming in at 20.36% of the portfolio. We're long Coinbase, which has just been skyrocketing up with 9 shares representing 34% of the portfolio. We're in the big major tech giants like Facebook, Google, Amazon, Tesla. Leverage times 3 with ticker FNGU, pick up 8 shares. And our energy hedge, which has been doing terrible, but I think it's going to pick up this year, and we're going to get ready to add to this as well as a oil play, is BOIL, betting on natural gas prices rising, 21 shares coming in at 5.44%. In 2023, the high-risk portfolio returned 14.6% in January total return, and in February, it's already jumped up a massive 22.95% with a year-to-date return of 40.9%. Last year, we had up to a 40% return, but we hit some losses in November that did pull us down to a negative 12% return overall for 2022. Not bad considering how nasty 2022 was. Everybody lost record amounts of money. 2021, we brought in a 233% return. And I'm hoping we can get somewhere close to that this year. Now, if you want to replace Coin or FNGU with a product that will dramatically outperform it in a private equity investment opportunity, it's called Rebel Dividends Corporation. It has a 81% year-to-date return. So it's outperforming the high-risk portfolio times 2, and it replaces Coin, FNGU, the Triple Q, or any stock position. It's going to give you better return in growth assets. Call Dean now to learn more at 505-322-7515. Okay, now we're going to look at the most recent charts and data I collected over the previous 2 weeks. They're the most interesting. So we're not seeing a recessionary warning in terms of unemployment rising too rapidly. We're seeing the economy cool off, and we're seeing all types of inflation in the rate of change slowing down. This is what the Fed wants to see to stop hiking interest rates. And so what in general has been happening is massive amounts of part-time jobs have been added to the economy, while about 10,000 full-time jobs have been removed. Here's a look at the change in average hourly earnings, and you can see they're cooling off into the 4 to 5% range. When the Fed was really upset and worried, we were looking at 7 to 8% wage inflation. Change in non-farm payroll employment had a huge jump today, and they went and revised the last year to have more jobs added across the board. So you're not going to get a recession when there's full employment. And so we'll look at the yield curve on the bond market to look at what happens prior to recessions. And it's a steepening of the yield curve, not an inversion. We're at the greatest inversion ever in the last 40 years, which is a good time to go long. It's when it steepens we want to get worried. So I'm looking at about a 1 to 2 year pathway for massive gains and essentially how we're positioned right now. Now also, the labor force participation rate would need to get back to pre-lockdown era. So we can't say that nasty word which caused us to lock down without getting censored on YouTube. But you can see there's still several million jobs not recovered from after we did the big lockdown. To get secular inflation that's sticky and will cause a 70s-like problem for markets where you had a decade of negative returns on stocks and bonds, we're going to need to see the labor force participation rate going sky high. And with a globalized economy, that's just not happening. Here's another look at average hourly earnings. And again, they're coming down. This is what we need to see. Unemployment rate is still extremely low. Prior to recessions, the unemployment rate skyrockets up. So it's just not happening. Here's a look at the federal funds rate through the 60s. And so what a lot of people are worried about, if you're a big bear, you're anticipating 1 to 2 decades of nonstop inflation. I want to point out from the 60s to the 80s, the US manufacturing sector was rapidly growing. And once we started to outsource everything overseas, you can see that the interest rates were falling because we had a deflationary force that was extremely strong. And I expect that trend to continue due to AI, automation, robots, and a continuation of globalization. So unless we start seeing the labor force participation rate rocketing higher, a massive decoupling from China to bring manufacturing back to the US, it's highly unlikely that we're going to repeat something like the 60s and 70s. Here's what the bond market's predicting. Essentially, a couple more rate hikes at most, and then the Fed's going to be able to start pulling back the interest rates slightly. So this is extremely bullish for markets. Here's another look at the federal funds rate against the 10-year. So green is the federal funds rate, and black is the 10-year. So we're playing the 10-year, essentially something like that with TMF. It's the 20-year, so just the same idea, but more leveraged. Essentially, if we think the federal funds rate is about to top out and stay flat, bonds are potentially the best investment with the least risk in decades of opportunity. And one of my heroes, Jeffrey Gundlach, is saying this is the best setup he's ever seen in bonds in his entire career. So we will maintain the huge bond position in our safe growth portfolio and a decent position in our high risk. But as you can see, if interest rates fall, TMF goes up exponentially. So really beautiful setup coming here. And it's without exception. When the federal funds rate pauses, interest rates begin to fall. And as long as you don't get a recession, then tech stocks and digital currencies are where you're going to make the most money. And then bonds are the safer bet, which is how we have you positioned and why we have such great returns is because we were predicting this. So here's a look at different ISM data. The services data came bouncing right back today above 50, beating all expectations. That's why you're seeing the bond market take a little hit today and a little bit pull back in stocks. Remember, stocks are valued relative to bond interest rates. So the higher the interest rate are on bonds, the lower the relative value of the stock market is. If we're predicting interest rates are going to begin to fall and the economy is going to remain healthy, that's going to drive evaluations of the stock market straight up from here. And that's why you're seeing stocks perform so well, because it's a big bet that interest rates will fall. Now, if we're going to look at a recession, again, look at the 2008 and the 2020 recession, and those levels went really low into the 30s. So we're seeing everything stabilize, housing prices stabilize, labor market is stabilizing, wages are coming down. We're not seeing a lot of layoffs. So this is really the Goldilocks soft landing being pulled off by the Federal Reserve currently. Wage growth of job switchers versus job stayers. So we're starting to see people be more happy and content with their jobs. Previously, when those lines at the right end of the chart were rising, that means people are flipping from job to job to job, getting a big pay raise over and over and over again. We're starting to see that stabilize and fall. So again, this is what we want to see. Now, are we about to collapse the global economy out of Europe because of the war? We've been watching this, and the PMIs are coming in good. Europe did a good job at preventing an energy crisis this winter, which was helped with extremely warm weather. And they've been switching over to other forms of energy and reducing output. So two big trends we're looking at for this year, once we see some sort of conclusion in the Ukraine-Russian war, is to see the European economy start to ramp up its manufacturing and industrial sector, which should drive energy prices higher, as well as the Chinese economy. But those have a very delayed effect. So I'm actually expecting to be pretty patient before we're going to get very aggressive on Boyle and NRG. We definitely jumped the gun a little bit or a lot, but luckily we were overexposed to growth assets. So we actually delivered a really beautiful return while our Boyle position took a big hit. This is an interesting chart comparing Spanish versus Eurozone inflation. Spain came in with a jump in inflation today, this week, which was a surprise to many. But in general, the European inflation is tracking the Spanish inflation as a leading indicator. And this is indicating that inflation is going to fall in Europe. Here's a chart of the China leads global inflation cycle by 7 to 8 quarters. This is essentially predicting we're going to have deflation all the way to the end of 2023. And then based on the credit boost that's happening now, we're not going to see that impact towards the end of 2023. So we're going to get a lot more worried about inflation having a comeback essentially towards the end of this year. So there may be more drawdown in oil and energy. That's catching everyone off guard because they don't understand the lag. And I'll be the first to admit, I got greedy on Boyle. We made a lot of money on that last year twice. In our third attempt, we did lose, obviously, so far. We're going to be patient before we add to that position, but I do anticipate that skyrocketing back up. But we may have just been quite a bit early on that play. Now, to be clear, I'm not saying sell your Boyle. The position you have now is tiny, and I'm planning to slowly add to that as I see the right indicators. There's another chart showing wage growth has peaked relative to the Atlanta Fed data of ECI. And essentially, these are all the things we're looking for the Fed to hit its dual mandate, which again is stable employment, maximum employment, and maintaining inflation levels. So the employment is doing great with these high interest rates, and the inflation is cooling off. So this is exactly what they want to see. Now, here's a look at what central banks have done in the last several months. And essentially, Bank of Japan and the Bank of China have done massive money printing while other central banks were tightening last year. This is typically what they do. They take turns tightening and loosening to keep the global economy running smoothly. And what we were saying is China had to wait for the US to stop tightening before they could stimulate their economy. Otherwise, it would crash their currency. So China is betting big, as well as Bank of Japan, that the US is on the verge of pivoting and pausing so that they can then stimulate their economies without crashing their currency and bond markets. And that's exactly what they're doing, why we've had such a nice rally in markets this year. Here's the dollar index against the S&P 500. They have an inverse correlation, typically, not always. We're expecting the dollar index, DXY, to essentially fall towards 90, currently at 102. So I'll probably be taking a lot of profits off the table on anything that goes up against the dollar as we approach that level. I think it's going to take about 2 years to hit that. And essentially, the US will be easing while other central banks are still slowly tightening. They're lagging us in that. Here's another look at total compensation falling in terms of the percent change year over year. Again, this is what we want to see. So all the data is really showing the same thing, a slowdown in the rate of change of inflation. We're not saying prices are falling. We're saying the rate of change of them increasing is falling, and that's what this is all about. Now, the government's trying to pass a $1.6 trillion omnibus bill, and the debt ceiling has been reached. So this is a huge bullish setup. That's kind of funny. Basically, Janet Yellen cannot issue any new debt until they increase the debt ceiling, and she has to dump all the money in the Treasury General Account, which is about $550 billion. So while the Fed's doing quantitative tightening, selling bonds into the market, Janet Yellen's going to be dumping by June, when the debt ceiling is going to become critical, all the money stored at the US government's bank account. So $550 billion is going to be coming in. Meanwhile, in the reverse repo, there's $2 trillion sitting. That's been starting to drain as well. now that short-term interest rates on debt products are becoming competitive with what the Fed was issuing reverse repo. So essentially, look for massive liquidity globally and in the US hitting the economy till about June. Once the government does increase the debt ceiling, which I'm sure they will, then Janet Yellen's going to be issuing a lot of debt. So I'm actually looking for a potential volatility event this summer, because that's when they're going to start having the double whammy. We're going to have inflation expectations rising, more bond issuance, and the Fed potentially still tightening. And you can see the majority of the federal budget are things that the voters would never give up, like Social Security, Medicare, Medicaid, defense, interest payments, and income support like SNAP. Okay, so there's just no way they're going to get rid of these major items on the balance sheet of the US government spending on a yearly basis. So this is just going to grow and grow and grow. It's the primary reason why we like to invest in stocks and digital currencies. Here's another look at it. It's just this unstoppable growth of debt to keep the show running. So buy your digital currencies and sit back for massive returns this decade. Here's another interesting setup. So we believe inflation is going to be falling and that interest rates are going to crash. And we showed you the history. When the federal funds rate pauses, interest rates crash. And that's because they have done their job to stop the inflation. This is the biggest short position in treasuries in history. And it's going to cause a massive short squeeze once these interest rates start to fall. So we love TMF. And it could potentially be one of the best returning ETFs you could possibly buy this year. Here's a look at the cash levels at $5 trillion sitting there doing nothing. So this is all going to be poured into the stock market and the digital currencies markets once there's more and more confirmation. Now, if you're a money manager, you look good if you reduce volatility during a bear market. But if you miss out on a bull market, you get fired. So you're going to see all the big money managers freaking out and going balls to the wall as we see the inflation fall over the next several months. And I believe the next CPI print will continue this trend. Another reason why we can't have interest rates this high for this long is it's becoming too large of the budget. You can see we're now paying over $800 billion a year in interest payments alone. If we go back to this chart, you can see that yellow box. That's going to become a big problem. The government must drive interest rates lower if it wants to grow debt. It's just the only way it happens. Now, a lot of people are saying, oh my gosh, everybody's running up their credit cards. But the truth is the balance sheet of the consumer is very strong. And they're still starting to sell off some of the trillion. They saved up over the lockdown period with all the free money, $3.4 trillion. And of that, only $1 trillion has been spent. So there's just massive amounts of money to be invested in markets. So time is now to get greedy. This is looking at the yield curve over 2000 to 2022. And the recessions happen not when the yield curve inverts, it's when it steepens. And so that's when we want to get worried, when the yield curve is steepening. Right now is the time to get super greedy because it means peak interest rates are here. And essentially, we're probably expecting a 12 to 24 month bull market ahead. Now, again, the fine balance, whether or not you want to be long growth stocks and digital currencies or bonds. If we thought we're going to go into a recession and crash the economy because the Fed had overdone this, then we would want to be long only bonds. If we think we have a Goldilocks situation with a soft landing and the economy is going to remain fine and dandy for a time being, we want to be long growth stocks. So the high risk portfolio is making the big bet that the economy is going to be fine. The safe growth portfolio is being more cautious with the bond position. So that's really the two differences in our two portfolios in terms of how much risk you want to take. So the housing market is now starting to stabilize. Very good news for the soft landing. This is looking at the PPI against CPI, predicting inflation will continue to fall for the foreseeable future. This is a chart comparing the M2 money supply year-over-year growth against CPI and PPI. And this is basically predicting we have essentially about 18 months of deflation coming in. Now, there's going to be some offsetting factors probably in about 6 to 9 months from China, Japan starting to print a lot of money. So that's something to look out for. How's the S&P 5 performed when the Fed hit pause on interest rates? It's been extremely bullish through history. The only exception was in the dot-com bubble, where the inflation kept rising and they had to resume rate hikes. Consumer spending still healthy and growing in the US, hitting new highs. Balance of trade, we're still importing goods, but it's slowing down. So you can see US consumers are slowing down all those Chinese imports. Good for the inflation picture, but not detrimental. We haven't stopped completely. Retail sales have fallen for the last 2 months. Good news. They're still at extreme highs, but we wanted that to slow down for inflation to cool off. Consumer credit continues to grow at a clip of $27 to $29 billion a month. Loans at banks continue to grow. You just don't see all this credit growth in a recession. So we look like we have a very, very nice setup. China's PMI is back above 50, showing that their economy is back online. And again, they were probably just doing all that lockdown stuff to cool off inflation in their economy until the Fed was done hiking rates to primarily protect their economy and their currency market. Chinese exports starting to rebound here, so no sign of the global production system crashing. Chinese imports starting to grow back as well. Okay, so that's the greatest slides I pulled out of the last 2 weeks of short-term data. Now we're going to go through each position and look at charts. Okay, so coin is our favorite position for digital currencies for the best return. Now you could replace this with Rebel Dividends. Call Dean to learn about it. This has been doing really well for us. It's up 35% in the last 5 days. So we nailed it with that trade. 3 months, it's up 42%. And so we basically nailed it. We got in almost at the very bottom and have had some really nice returns. There's a lot of room ahead for coin. If you switch over to Rebel, we'll be long a better asset with essentially 200% leverage. And I can't say too much of the terminology, otherwise we will get censored. But you all know what it is. And that product's outperforming the high risk portfolio 2 to 1. So we'll flip through those, but seeing really nice returns in those products as well. And again, the main reason we want to be long digital currencies is betting that governments will spend more money than they make to win votes, and that this is a trend that's not stopping anytime soon. You add in the deflationary forces of automation. Think of products like ChatGPT are now replacing engineers. So the cost of delivering goods is going to fall, and all these people are going to need money from the government to really survive. And so that's why we see this trend just continuing to grow for the next decade or more. Here's the US federal's own budget deficit projection, growing from 1 trillion to 2.3 trillion by 2032. It's really all you need to know to have a very strong conviction trade on digital currencies. As far as the halving cycle is concerned, which also happens to line up with the bond market cycle, we're expecting this to top out for interest rates to hit a bottom around 2025, early 2025. Okay, so if you want to get more information, call Dean at 505-322-7515. Okay, let's look at commodities now. This one's been a bloodbath for us. We made a lot of money on that last year. Got pretty greedy on it around December, and it's just been crushed. We added to it once, and then we've been patient. I was thinking about adding it this week, but it continues to just get beat down. And now I'm thinking we have to be a lot more patient. Perhaps even all the way to this summer. So I'll be watching this data very carefully, especially with 500,000 new conscripts about to rush into the war. And that's escalating very, very quickly. So that's something I'll be paying a lot of attention to. But let's just take a look at the charts. Oil down 25% the last 5 days, down 84% the last 3 months. Is probably going to bottom out here soon. So I'll probably be slowly adding to it all the way into summer. So we'll just have to keep a close eye on it, but just massive, massive pullback in that asset. The other product we like is NRGU. These are the big US oil companies, leverage times 3. They're having record profits and they're doing massive stock buybacks. And I think we're going to see oil stabilize within the summer time frame and then probably ramp up towards the end of the year. So I think I got the timing wrong by potentially 6 months. Don't change your position. I like the size we have now. I'll be slowly adding into that. Timing's the hard part of this game, as you know. So NRG is the other ETF we'd like to use to hedge against inflation. And we're just gonna be a little more patient. That's why we didn't do a trade alert yesterday, even though we predicted the outcome of the FOMC. And again, the positions we're in were the top performers, so we nailed it. Here's oil over the last 5 days. So China's reopening. What the hell? Oil's down. We got the Israelis bombing Iran, which could reduce supplies. So, you know, you got all the catalysts there. You got to be patient for the energy play to come back. Over the last 3 months, down 15% and down 13% over the past year. Another reason to believe why inflation is going to stabilize and fall. We're not seeing the most volatile input of inflation going back up yet. Okay, so the crash insurance play, this could become more attractive, especially as we get towards summer when I see the bond market having issues. Again, to repeat, this summer, Janet Yellen's going to have the debt ceiling lifted and start issuing bonds, as the Federal Reserve is also selling bonds into the market. So there's going to most likely be a risk of interest rates rising post-summer, which will make the valuation of stocks go down. Again, if interest rates rise, the valuation of stocks goes down. They have an inverse relationship. So I'm looking for the potential to add to energy and hedge against bond volatility via UVXY heavily the closer we get to June, or whenever the hell they lift the debt ceiling. But I think the Republicans in the House will hold it up until the last second. This product was actually going up with stocks yesterday. That's due to the volatility in options pricing, but it's down 48% in the last 3 months. We haven't touched this for almost a year now, but I do think it'll be time to top up on UVXY as we approach summer. Here's what it did in the 2022 lockdown. So it can do its job with asymmetrical returns when you get a massive crash from a black swan. So that's what's been giving markets the extreme volatility, something they just couldn't think of. And that's why you have it. It's for the risk we don't know about that could hit markets. So 25% decline in the SPY in a single month drove UVXY up 1,000%. If you had 10% of your portfolio in that, you could have lost the other 90% and broke even, because 1,000% times 10% doubles your total portfolio. The bears for a big crash, in my estimation, would need a surprise jump in inflation, or you know, an attack on the internet. We've got the globalist warning, and that's the next big thing to be worried about, or World War III perhaps. So this is the 2008 VIX. You can see it was tracking like this, came back down, and then spiked. And so that's what we're worried about and why we would own UVXY. Okay, bonds, buy 49 shares of TMF. This is a bet that interest rates will fall because inflation's falling. Over the last 5 days, it was up a lot more until this morning. The jobs report today pissed off the bond market again. But again, this is good because we believe inflation's falling and the labor market's strong. That's the Goldilocks situation we want for our long positions currently. Over the last 3 months, it's up 32%, but the Treasury market went through a 2-year bear market, one of the worst in its history. You have to go back to the 60s, 70s, and the Great Depression to find similar bad times. Here's the TLT, which is what it's leveraged into, and of course, very similar returns. Okay, we're not in these positions, but we're looking at them because this funds the stock market, and they're buybacks, stock buybacks. The investment grade corporate bond is up 0.4% in the last 5 days. It's up 9% in the last 3 months, and had the same trend as the US bond market last year. So 2-year bear market coming into a bull market. The high yield junk bond market is showing the same trend, up in the last 5 days, up in the last 3 months, bottomed out around the exact same time in October of last year. The 3-month on the US Treasury market is flatlining at 4.6. So I'm thinking the Fed will do another 25 basis point rate hike next month in March, and then in May, the upcoming meeting, that'll be when they pause. And so far, the bond market on the short end looks like it's stabilizing. All these short-term bond markets are trading flat over the last several months. So the 2-year over the last 5 days essentially flat, and it's down over the last 3 months. Beautiful. Usually the 2-year predicts the federal funds rate. The federal funds rate is now at 4.5 to 4.75, and the 2 years at 4.26. So they may even pause at the next meeting. The bond market's telling them they should. Okay, the 10-year trend in this chart of the last 3 months, again, this means interest rates are falling. You're making money owning the 10-year bond. Over the past year, it had risen, and you can see it hit a peak in October and has been falling ever since then. 30-year has the same trend. Okay, European markets, same thing. Some other inputs, lumber futures, this was going sky high during the inflationary period. No sign of that. It is starting to rise a little bit, to be fair, in 2023. But overall, you can see it's down 52% from the highs. Copper futures have been starting to rise again with the Chinese reopening. But if we look at the 1 year, it's this is one of the only commodity products that's actually rising. Everything else has been pretty much crashing. Baltic Dry Index, the cost to ship commodities around, down 55% in the past year. So everything is coming back to normal. So this is looking really good. Wheat futures are still down 10% over the last 3 months and flat over the last year. Here's the inflation rate. So we can see in the 70s and 80s, we had these skyrocketing inflation rates, but then they crash. And we're predicting that's going to happen as well, that the inflation rate is going to crash. This is going to be extremely bullish for bonds and growth stocks. And again, I think it's going to happen until at least this summer. We may have a reversion post-summer when the debt ceiling is lifted. And that's where we're going to want to be more heavily hedged in energy products. We're seeing a bounce in the consumer sentiment. Initial claims are still weak, so no reason to think the labor market's about to fall off a cliff. This is how inverted the yield curve is, negative 0.69 on the 2 and 10 year. Again, that typically means peak interest rates are here. Now remember, last few recessions, the yield curve was steepening, not inverting. So that's when we'll get more worried, is when this is steepening up towards a big spread. So that means the 10-year should have a higher interest rate than the 2-year. Right now, it's the opposite. Okay, we're not in the dollar position right now. We're expecting this to fall. I'm going to skip to the best slides for this. So we hit a peak of 112. I'm expecting this cycle to go down to about 90 around 2025. There's going to be volatility, of course, but that's when I think it's going to be a prime time to take massive profits and essentially bet on a recession and a crash. And this is based on the bond market cycle and where we think interest rates will bottom out. Okay, here's a look at FNGU. This is the other big play we have. It's 10 big US tech companies, leverage times 3, and it's skyrocketing up 31% return in the last 5 days. And you can see we went very aggressive on that this year, and it's really paying off. Now, where could it go to? Well, it came from about 360 and we're at 89 today. So there's a lot of upside. This is one of the positions I want to sell when the DXY hits around 90. Let's just look at some indexes now. The S&P 500 is up 2.37% in the last 5 days, 11% in the last 3 months. And it looks like it's bottomed out and getting ready for a bull market cycle. Now, if we hit 420 to 424 on the SPY, it's going to cause massive buying systems to go into place. And that's when we could get a melt up to above 440. The Fed won't like that one bit. So we'll see if that plays out. NASDAQ's up 5% in the last 5 days, 18% in the last 3 months, down 14% over the past year. Again, very similar pattern as the S&P 500. Emerging markets have been in really well this year, down in the last 5 days by 1.9%. Over the last 3 months, up 17% on the Chinese reopening data. And again, it's bottoming out right when the bond market bottomed out. These are highly correlated. Emerging markets could greatly outperform US markets this cycle. The purple is when emerging markets outperforms US, And essentially it happens when bond markets and inflation peak and there's a very deflationary cycle coming in. And that's exactly what we had. We had a 2-year bond bear market that's bottomed out last October and probably has a 2-year run on it at least. So emerging markets with ticker EDC, it's EEM times 3 is how we're playing that in the safe growth portfolio. Now in Europe, we want to be worried about contagion from all sorts of bad policies and the war risk. So we're not seeing their stock market crash. In fact, it's up 22% in the last 3 months. What war? We're not in uranium right now. This will be a potential energy play we want to look at to diversify this summer. So essentially, it's looking like this summer is going to be a good time to load up on various energy plays based on the Chinese credit cycle. Rare earth metals, same thing. This is what powers all the battery products from a Tesla to an Apple phone, and likely load up on that this summer. I'm going to skip through the individual charts. They're all doing extremely well. Apple, Google had really bad earnings yesterday, and they've already recovered those losses. So the market's just getting ready for lower interest rates and higher valuations at this point. And you can see all these charts just going straight up, and we nailed it with FNGU. Facebook having one of the biggest market cap jumps in its history. And again, a big position in FNGU. So just all of them are just skyrocketing up. Okay, the banks are going up, so the banks are looking very healthy. We're not seeing some sort of recessionary warning from the banking sector. All of those are screaming higher. Over in the Asian index, we're looking at Taiwan Semiconductors doing very well, up 57% in the last 3 months. That's one of your biggest positions in EDC. Tencent up 70% in the last 3 months. Again, a big position in EDC. Samsung up 10% in the last 3 months. So everything's looking very healthy. Okay, here's our disclaimer. I'm going to look at questions while I leave Dean's phone number up, and then we'll jump into any questions. But yeah, basically, I don't see us doing many changes in the near term. Martin says, can you elaborate on ChatGPT? So ChatGPT is an AI product that can do all sorts of stuff. One thing it can do is write software programs. So you can describe a software program and it can write code, or you could give it one language and tell it to convert to another code. So yeah, ChatGPT and AI in general are going to make the cost of goods drop over time, which is a highly deflationary benefit to the economy. And we're just now seeing the power of it unleashed. I think people are going to be miscalculating just how powerful AI will be in terms of deflation. So we'll be back for our next webinar Wednesday. Yeah, George says, here comes Robbie the robot stealing all our jobs. Well, in general, technology has improved the quality of life and created more jobs and lowered the cost of goods and services. But yeah, it could get to the point where there's just too many humans and not enough intellect in those humans to provide usefulness to the economy. As far as interest rates go, AI means lower interest rates and probably more debt. So go long Rebel dividends, essentially. Aaron says, do you have a go-to? Yeah, buy digital currency. Rebel dividends is a good way to benefit from the big deflationary shock of AI and what it's going to force governments to do. Basically, universal basic income is going to become a thing. Ron says we're not going to sell BOIL this March. No point to sell it now. We lost everything in it. We're going to add to it. I was early. The cycle is likely going to peak this coming winter. So I actually think we'll be holding to next winter now, and that we'll be slowly building into it until summer and then hold on to it from there. Yeah, we hit it really good twice, and then the warm weather. So here's what really happened that went wrong with BOIL. We had really record warm weather in Europe, 1. 2, Europe reduced its natural gas consumption in half. 3, they filled the hell out of it and had shippers all over the continent. So there's an oversupply, and they shut down the industrial sector. But this has driven the price so low that it's now unprofitable for many of these producers. And we're going to see demand pick back up because it's such a cheap way to create electricity. Now natural gas is a very cheap way to create electricity. So I think the demand's going to come right back. No, I think it's going to bottom out now and then slowly rise till summer and then skyrocket into winter is what I'm thinking for Boyle. So I wouldn't sell. Yeah, we're way below all the moving averages for Boyle. So we're going to be patient. We're going to slowly add to Boyle and take profits off bonds, coin, and FNGU to finance it. Yeah, coin is still, the whole portfolio is a great buy. So in your email, you're getting, if you're getting the unit of, let me go to the unit investment. You're getting $100,000 trailer, and then you're getting the single unit. And if you log into the membership area, you can just punch in exactly how much you want to invest. And so all of our members follow a ratio of stocks. So we all get the same return over the same period of time. Look at all these slides. Okay. So this is the ratio you should have. 20 UVXY, 49 TMF, 9 coin, 8 FNGU, 21 Boyle. If you want to double it, then you'll have 2 units. If you want to triple it, you'll have 3 units. Don't pick and choose what you like. You want to buy 1 unit at a time at the same time, and then save up enough money to buy another unit. And in your email, there's a link to get to this calculator with your login info, so you can punch in how much you want to invest, and then it'll print out exactly what to buy. So to be clear, we're interested in a ratio of shares. We're not interested in the asset allocation percentage. The asset allocation percentage is going to jump up and down. The ratio of the shares is going to be stagnant. And this has been performing extremely well this year, as is. My expectation is to slowly peel off TMF, coin, and FNGU and add to Boyle and NRGU for the high risk portfolio. And the safe growth, something very similar, but we'll probably also add in REMX and uranium. So lithium and uranium exposure. Yeah, so the portfolio is good by right now. We're at the very beginning of a 2-year cycle where we're going to probably see an inflection point this summer that's short-lived. And again, our prediction of the inflection point this summer is based on Janet Yellen has $500 billion to dump into the economy before she can legally increase the debt ceiling. And the House is going to hold this up to the last second. So we're going to run out of extraordinary measures that Janet Yellen can use to keep the economy alive until about June. So the Republicans are going to do whatever the hell they can to get whatever they want, but at the last second, guaranteed, they're going to capitulate and increase the debt limit and pass all this spending through. And that's when Janet Yellen's going to have to start raising money, as the Fed's also selling bonds. We're going to have a lot of bond issuance around summer. Till summer, there's going to be a very muted bond issuance in the US. So I'm seeing a massive melt up through summer, basically. And it may be so powerful that the debt ceiling doesn't create a big pullback. We'll have to see that as we get there. Yeah, we still have GBTC. No change there. I think it'll go up. Yeah, I think Boyle's going to be a very good long-term play. We're going to be in and out of Boyle and NRGU for the next 30 years because there's no way they can replace those 2 energy sources. And usage is going up. So unless there's some devastating, either we need a new source of energy that we don't know about, or we need a lot of people to disappear. Otherwise, energy usage is going straight up for the next 3 decades. And the main source of that energy will be coal, natural gas, and oil. Real simple. Yeah. Yeah, and I also, so uranium could be a good replacement of energy. And then the batteries, the lithium is the single ingredient that there's not enough of. And REMX gives you that. So yeah, I like oil, I like EnergyU, I like REMX, and I like URA for an inflation hedge. But I do think we need to be patient. I jumped the gun on it, expecting a cold winter and a drawdown in the European storage, but we're wrong. John's wondering if I think the government's gonna, no, so Coinbase won a huge lawsuit. That's why it's been skyrocketing up. Its valuation is extremely low. It's like, well, now it's jumped a lot, obviously, but it was being valued at its IPO price, but its user growth is 10 times since its IPO. So it's just a screaming deal. But I would replace Coin with Rebel Dividends. So again, call Dean. Any stock, any tech stock or Coinbase. So Triple Q, GBTC, ETHE, FNGU, that can be replaced with Rebel Dividends for better return. And I personally manage it for you. NRGU will be definitely added to the portfolio this year, guaranteed. Timing, probably slowly leg into it into summer. Very, very slowly and patiently is what I'm thinking now. 25,000 minimum to get into Rebel. Once you're in, you can add any amount you want. So we got some people adding $500 every couple times a week. Good. Aaron's very happy with Rebel Dividends so far. Okay, great, guys. I'm going to go ahead and let you go for the weekend. Great returns this year. We'll be back on Wednesday. And if you're in Rebel Dividends, we got a webinar Tuesday and your dividend going out Monday. John said, yeah, so you can get in and out of Rebel Dividends on demand, but it's not on an online platform. You just call us and say you want to sell your shares. But yeah, there's no lock-in period and it's highly liquid. So we can get you in and out on demand. Okay, thank you guys so much. We'll see you back Wednesday. Have a great weekend.